Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden in plain sight within corporate filings, and sometimes those secrets are about companies not telling you the whole story, or maybe they are just going away. In this report, we're looking at a collection of annual shareholder reports from ATAC ETFs, and let me tell you, some of these funds had a bit of a tough go, with one even heading towards liquidation. So buckle up, it's going to be a bit of a ride through fund performance, market shifts, and some serious strategic changes. And hey, if you like this kind of deep dive into financial documents, make sure you subscribe and join our Discord community, linked in the description. Alright, let's get straight into it. We're looking at a certified shareholder report for registered management investment companies filed under Form N-CSR. This is where we get the lowdown on what has been happening with several ATAC exchange-traded funds, or ETFs as they're commonly known. First up, we have the ATAC Credit Rotation ETF, with the ticker JOJO listed on N-CSR. This report covers the period from September 2024 to August 2025. Looking at the costs for a hypothetical $10,000 investment, it came out to $102, which is about 0.98%. Not too bad for a year, but when we look at the actual performance, yikes. Starting with $10,000 on the 15th of July 2021 by the 31st of August 2025, that investment was only worth $9,188. That's a pretty significant loss, especially compared to the benchmark, the Bloomberg US Aggregate Bond Index, which would have left you with $9,692. Not exactly a stellar performance, is it? For the 1 year period, the ATAC Credit Rotation ETF returned 7.60%, but looking at the bigger picture since its inception on the 15th of July 2021, it is actually down 2.03% annually. The benchmark, however, managed to be down only 0.75% annually since then. Clearly, this fund struggled to keep pace. The report explains that the fund generated a 7.60% total return, outpacing its credit on credit off index, but still lagging the benchmark. They mention that market conditions like moderating inflation and shifting interest rate expectations did help some investments rally. Apparently, rotations between high-yield bond ETFs and treasuries were supposed to work well, and long-duration treasuries did perform well. The fund's positioning in both high-yield bond ETFs and treasury ETFs was additive to performance overall. So, based on the explanation, it sounds like all the right ingredients were there, but the final dish did not turn out as expected. As of the 31st of August 2025, the fund size was about $6.5 million. Pretty small. The number of holdings was only 4. And get this, the portfolio turnover rate was a massive 141%. That means they were buying and selling assets almost all the time, which generally leads to higher costs and often lower returns. The fund was heavily invested in just 2 ETFs, the iShares iBoxX Dollar High Yield Corporate Bond ETF at nearly 70%, and the Xtrackers USD High Yield Corporate Bond ETF at about 30%. Basically, they were all in on high yield corporate debt. Now, for some significant changes, effective May 2, 2025, Tactical Rotation Management, LLC or TRM, became the new sub-advisor. And then on the 1st of August 2025, US Bancorp Fund Services, LLC, doing business as Global Fund Services, stopped being the sub-administrator. These are big operational shifts. Next up, we have the ATAC US Rotation ETF, ticker RORO. Also on N-CSR, this report also covers the period up to the 31st of August 2025. For a $10,000 investment here, the cost was $95 or 0.98%, similar to the other fund, but the performance story here is even more dramatic. Starting with $10,000 on the 17th of November 2020 by the 31st of August 2025, this investment was worth a mere $8,687. That is a substantial loss over less than 4 years, and the S&P 500 Total Return Index, which is a much broader market indicator, would have turned that $10,000 into over $19,000. That's the difference between losing money and nearly doubling it. For the most recent year, the ATAC US Rotation ETF was down a whopping 5.93%, and since its inception on the 17th of November 2020, it is down an annualized 2.90%. Meanwhile, the S&P 500 achieved annualized returns of over 14% in the same period. This is a huge underperformance. The report states that this fund lost 5.93% for the year ending the 24th of October 2025, which was apparently its liquidation date. So yes, this fund is being shut down. They blame market volatility, shifting inflation and interest rate expectations, and uncertainty about economic growth. The strategy here was tactical shifts between high-yield bond ETFs and treasury ETFs. Apparently, these rotations were hindered by inflation data and market retrenchments, leading to negative relative performance, especially compared to equity benchmarks. The report also mentions that defensive postures weighed on results as equity markets rallied strong into mid-2025. So, it sounds like their defensive moves backfired. As of the 31st of August 2025, this fund was even smaller, with a fund size of about $3.5 million. Number of holdings was 4, and the portfolio turnover rate was an insane 1735%. That is incredibly high turnover, indicating very active trading. This fund was split between Treasury bond ETFs, the eShares 10 to 20 year Treasury bond ETF at 65.5%, and the PIMCO 25 plus year 0 coupon US Treasury Index ETF at 34.4%. So, they were heavily concentrated in long-term treasuries. Similar to the other fund, TRM became the sub-advisor on May 2, 2025, and US Bancorp Fund Services ceased being the sub-administrator on the 1st of August 2025. But the big news here, and this is crucial, on the 3rd of October 2025, the Board of Trustees approved the closure and liquidation of this fund. It is game over for the ATAC US Rotation ETF. Now we move on to the ATAC Rotation Fund with ticker ATACX. This report also covers the period up to the 31st of August 2025. This fund has two classes of shares, investor class and institutional class. For the investor class, the cost of a $10,000 investment was $185 or 1.75%. This is higher than the other ETFs, likely due to the higher expense ratio. Okay, let's look at the numbers, starting with $10,000 on the 1st of September 2015. By the 31st of August 2025, the investor class of the ATAC Rotation Fund was worth $18,581. That is a gain, but look at the S&P 500 Total Return Index. That same $10,000 would have grown to nearly $39,076. So, while this fund did grow your money, it lagged the broader market significantly. For the last year, the ATAC Rotation Fund investor class returned 10.91%, which sounds good, but again, the S&P 500 returned 15.88%. Over 5 years, the ATAC Rotation Fund is actually down 1.33% annually, while the S&P 500 is up nearly 14.74%. Even over 10 years, the ATAC Rotation Fund investor class is at 6.41% annually, far below the S&P 500 at 14.60%. This fund has consistently lagged. They mention a 10.91% return for the investor class and 11.19% for the institutional class, which is indeed higher on a yearly basis. They attribute this to market rallies on confidence about cooling inflation and potential central bank easing. However, they also note that it was difficult to benefit from risk-off sequences because volatility was mostly suppressed. The report highlights a few key factors. First, narrow market leadership driven by a few mega-cap tech stocks meant that the fund's focus on broader segments like small-cap and emerging market equities underperformed. Secondly, interest rate dynamics meant that bonds and stocks sometimes moved in the same direction, weakening the usual risk, off benefit of treasuries. On the flip side, they benefited when the rally broadened and their risk, on signals kicked in with leveraged exposure to equities being particularly advantageous. Top contributors included leveraged small cap equity exposure, which amplified gains when the market rallied. However, emerging market equities underperformance and treasury bond positioning detracted from performance. High inflation and interest rates pressured bond prices. As of the 31st of August 2025, this fund had a fund size of about $9.9 million. Number of holdings was 6, and the portfolio turnover rate was a very high 1.327%. Again, this indicates very active management and trading. The fund was almost entirely invested in exchange, traded funds at 99.4%, with only a tiny bit in cash and other. The top holdings were all small cap ETFs, eShares Core S&P Small Cap ETF, Schwab Small Cap ETF, Direction Daily Small Cap Ball, 3X Shares, eShares Russell 2000 ETF, and Spider Portfolio S&P 600 Small Cap ETF. This shows a heavy concentration in small cap equities, especially leveraged ones. We see similar sections here for the ATAC Rotation Fund, with a focus on the investor and institutional classes. The sector breakdown is 99.4% exchange, traded funds, and 0.006% cash and other. The top issuers listed are all small cap ETFs, again reinforcing that concentrated bet. This section details a reorganization on the 14th of July 2025 where the predecessor fund merged into the current fund. Tactical Rotation Management, LLC also started serving as the sub-advisor. They also note that US Bancorp Fund Services is no longer the sub-administrator, effective the 1st of August 2025. Importantly, a new accounting firm, Tate, Weller and Baker LLP, was appointed. Now, let's look at the financial statements for the ATAC Rotation Fund, investor class and institutional class. Keep in mind the report year ends the 31st August 2025. The schedule of investments shows almost 100% in exchange-traded funds, specifically Direction Daily Small Cap Bull, 3X shares, and several others focusing on small cap ETFs. Looking at the total net assets, the investor class is around $10 million and the institutional class is about $39.6 million. For the year ended the 31st of August 2025, the ATAC Rotation Fund investor class had net investment income of $865,780. But here is the kicker. The net realized gain from investments was over $3.7 million and the net change in unrealized appreciation was negative $63,985. So, while they had gains on sales, the value of their holdings dropped. The net increase in net assets for the year ended the 31st of August 2025 was a substantial $4.5 million. However, when you look at the capital transactions, there were significant redemptions, particularly for the institutional class, which saw over $10 million in redemptions. That is a big outflow of money. Let's look at the per share data for the investor class. NAV at the beginning of the latest year was $35.49, ending at $39.01. The total return was 10.91%, which sounds good, but compared to the S&P 500's 15.88% for the same period, it's still a lagging performance. The ratio of expenses to average net assets after waivers for the investor class was 1.75%, which is quite high compared to many ETFs. The notes provide crucial context. They mention the reorganization on the 14th of July 2025, where the fund merged into Tidal Trusti. They also discuss fee waivers and expense reimbursements by the advisor, Tidal Investments LLC, to keep expenses down. Notably, the advisor has agreed to waive fees to ensure total annual operating expenses do not exceed 1.69% for the investor class and 1.44% for the institutional class. This is a strong indicator that without these waivers, the fund would be very expensive. The audit report from Tate, Weller and Baker LLP states that the financial statements present fairly in all material respects the financial position and results of operations. They served the fund since 2018 and conducted audits according to PCAOB standards. This is standard boilerplate for an audit report. Here, they discuss qualified dividend income and dividends received deduction. For the ATAC Rotation Fund, about 20.59% of ordinary income distributions qualified as qualified dividend income. For corporate shareholders, 8.26% of ordinary income distributions qualified for the dividends received deduction. This is getting into tax specifics which, while important for investors, are less about the broad strategy and performance story. This section is quite extensive and reveals a lot about the board's decision to approve the advisory and sub-advisory contracts. They reviewed performance, nature of services, cost of services, and economies of scale. For the ATAC Rotation Fund's advisory fee, they noted it was 1.25%, higher than the peer group average of 1.01%, even after fee waivers, bringing it down to 0.98%. It was still higher than the peer group average of 0.866%. The board acknowledged this, but approved it, noting the advisor's agreement to waive fees and reimburse expenses. They also considered the performance of the predecessor fund and the qualifications of the portfolio managers, including a key manager named Michael Gade, who has been involved with the strategy for a long time. The approval of the sub-advisory agreement with TRM also involved a thorough review, with a focus on Michael Gade's continued role. Overall, the story here across these ATAC ETFs is one of mixed performance, significant strategy shifts, and for at least one fund, a planned liquidation, the ATAC Credit Rotation ATF and ATAC US Rotation ATF struggled significantly with performance, with the latter being liquidated. The ATAC Rotation Fund, while showing gains, consistently lagged the broader market, and its high turnover points to a strategy that, while active, did not translate into outsized returns compared to simpler market investments like an S&P 500 index fund. The high expense ratios, even after waivers, also raise questions about long-term value for investors when compared to passive alternatives. So, what is the verdict? The ATAC Credit Rotation ETF and ATAC US Rotation ETF appear to have had serious issues that led to poor investor returns, and ultimately liquidation for one of them. The ATAC Rotation Fund, while it did not liquidate, has a track record of significantly underperforming its benchmark, suggesting its complex rotation strategy may not be delivering the promised absolute returns, especially considering how expensive it is. The heavy concentration in small cap ETFs, particularly leveraged ones for ATAC rotation, presents a high risk, high Reward profile that clearly did not pay off consistently in this period. The takeaway is that complex, actively managed strategies, especially those with high turnover and leverage, are very difficult to execute successfully over the long term. Sometimes the simplest approach, like investing in a broad market index, offers better risk-adjusted returns, even if it seems less sophisticated. That is our deep dive into the ATAC ETF filings. What is your take on these performance numbers and the strategies employed? Let us know in the comments below. If you found this breakdown valuable, smash that like button and subscribe for more corporate insights. And as always, check out the link in the description to join our Discord community for more discussions. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.